It's been a very strong start to 2020, particularly for the Australian equity market. Really, it's an extension to what occurred in markets during 2019. In the first chart, what we're going to be having a look at here is the composition of returns or drivers of returns over on an annual basis since 2010. And I suppose just highlighting the most recent period, the dark blue bars show PE expansion contributing about 20% to the overall 23-24% gain in markets for 2019. We could do the same for the US, and that is shown on this particular chart. This is looking at it over a longer time period, but basically the same story, and that is one of PE expansion, the dark blue bars contributing, in the case of the US, about 24% to the overall 31% return in markets, with EPS basically flat to even slightly negative and dividends in the low twos. So a clear pattern emerged across global markets during the course of 2019. Now, if we look at the last 10 years, so I'm tracking the Australian equity market with a base of 100 in at the end of 2009. So the market here is up around 110% roughly over that over the decade to December 2019. What about the contribution from EPS? That should show here, and essentially that's the red line that we've added there. So earnings have grown by a little bit under 40% over the entire decade. So very minor or quite a poor earnings backdrop that we've seen over the past 10 years. And clearly it's been the decline in bond yields that has assisted in PE expansion. So if we add the bond yield to the right-hand side, just correcting this scaling somewhat, and you can see that the bond yield, the dark blue, has come down from about 5.5% down to sort of or low ones. So bond yield decline has been a significant factor, not only over the past 10 years, but also obviously over the past 1 year in particular. Now, if we then look at returns from Australian equities over the past 10 years, on a rolling 10-year basis, what you'll see here is that the dark red line is the overall return, total return. So in the Australian market, it's been 7.9% per annum. About 4.25% has that been from the red bars, which is dividends. About 2% from PE expansion, and about 1.5% or thereabouts from EPS growth. So very much returns being driven by dividends and also PE expansion, in turn declining bond yields over that period. Now the same chart looking at the US market, we'll break this down once again, looking at the sort of 10-year returns, and that's the US S&P 500 total return index. So it's up about more than 250% over the decade. But in the case of the US, earnings have actually been quite a strong contributor. As we can see here, the red line there, earnings growing by roughly 175, 180% over that time period. And yes, sure, bond yields were a contributing factor to PE expansion, but it wasn't the major driver over the 10-year period, as we could see here, with bond yields really falling. Well, I suppose, going back to 2010, bond yields were, 3.5, a bit above there, but pretty much since 2011, they've been in a 1.5 to 3% band. So that's the sort of summation of where returns have come from. Just quickly, once again, that 10-year chart in the case of the US, the return composition about a little bit over 10% from EPS growth. Dividends around the sort of 2.5, 2.25%, and PE expansion. So very much an earnings story in the US over the past 10 years. It's interesting to look at what's happened to the implied discount rate, and I'm going to look at the US implied discount rate on the equity market, and we can see that obviously it fell sharply during the 1990s, but pretty much for most of that period it's sort of been around about 8%. But right now the implied discount rate has dropped to about 7.6, 7.7. So it's basically on the cusp of, or very near the lowest levels that we've seen. Um, so that's an interesting observation. The other one, of course, is to look, if we throw on to that chart the US 10-year bond yield, and that's obviously been a key factor in terms of dragging down discount rates across all asset classes. But US equities haven't obviously followed the decline in bond yields to the same extent. And by just now adding the equity risk premium, I shall put that on a more typical scale. So the dark blue line is the equity risk premium based on this dividend discount model. And you can see from sort of 2008, it ratcheted up into a new range, really between about 5% and 7%. So it's sort of sitting roughly in the middle where we sit at the moment. So, obviously the equity risk premium is elevated relative to the previous 20 years, but it's well within the range of the sort of post-financial crisis period. Now, we can just add a regime, and I'm going to add global IP recovery regimes. So they're been shaded in blue, and it's interesting just looking at the past 3 industrial production recoveries, and that's, of course, markets are basically expecting to see that over the next 6 to 12 months. But we can see what's happened to the equity risk premium in those periods. So the 2017-18, we had the IP recovery, and the equity risk premium fell from, a bit over 6% to down to the lower end of the range, around about 5%. It also happened in the 2013-14 recovery, and also in the 2009-2010 IP, recovery during that period. So, on the basis that we do see a recovery in global production over the next 6 to 12 months, one would expect perhaps to see the equity risk premium drift back into that 5% level from the current 5.75, but it could, I guess the big question is whether it's done entirely through a move up in bond yields, because in the previous 3 recoveries, bonds have moved from sub 2% to close to 3% here, and also, a little bit higher in 2009-10. So part of it can be achieved, or the decline in the equity risk can be achieved by rising bond yields, but also could be potentially achieved by a further decline in the discount rate, although that would be unprecedented with the discount rate already at its lowest levels, according to this time series. Just want to now finish up with a quick little look at the relationship between real bond yields and PEs. So we're grabbing that, and we're going to look at these in terms of an XY chart, going back to we'll go back to this period. So basically, declining bond yields, as we said, has been a factor behind the PE expansions, but could we expect further declines in real yields to achieve the same sort of outcome? So already we see that the pink dot there shows where current real yields are in the US. They're basically slightly negative. And PEs are on the y-axis, real yields are on the x-axis. So you can sort of see on this chart that further, or historically at least, further declines in real yields haven't been really associated with expanding PEs. In fact, the opposite. The further real yields decline, it's generally been a negative for multiple expansion, and also on the flip side, where real bond yields have pushed above the sort of 4% level, it's also been associated with quite low valuation. So to rely on further declines in real yields as a driver in further PE expansion would be contrary to what we've seen historically. Thank you.